traditionally we thought that the old 60-40 portfolio of 60% stocks, 40% bonds was going to provide that cushion. This is, 22 and into this year was like the first time in basically in the last 40 plus years where that hasn't worked. And it's worked very well for most of our lifetimes. But when you start adding in these different alternative investments, you really have a chance to diversify your performance and diversify your risks, and that over longer periods of time. This is not quick buck kind of thinking per se. There are some things you can do that are just kind of trying to get some quick wins. But just in general, if you think about your financial future over a longer time horizon, the diversification benefit you get from alternatives can be quite powerful.
So even in real estate, we have got the giant-sized real estate funds that diversify their investment holdings within the real estate world. So they would have some of their money in debt, which is real estate mortgages. They will have some of their money in real estate that is under construction. They could have some of it in raw land, and they're just doing land banking, waiting for it to be developed. And of course, they will have a large chunk of holdings that are in income-producing real estate, things that have already stabilized and are generating income for them. Because if you don't diversify, even within the real estate segment, look, right now, the higher interest rates all of a sudden is killing quite a few US and European developers. The shares have tanked. But if you are in real estate debt, at the same time, you are able to increase your interest for real estate debt that is newly issued out. So within real estate world, you need diversification too.
Matthew, you said that it worked, the 60-40 worked well for 40 years or so. Now we're on the cusp of change, or we are in the thick of change already. And as a result, that hasn't worked so well. So alternatives have come in. Is it changing the shape of investment and investing on a more permanent basis? Is that 60-40 thing going to be out the window? And we're now looking at a 50-30-20, which could become a 40-30-30, or what? How do you see it?
Yeah, I think it really depends on which kind of investor you're talking about. I think if we go back to the mid to late 80s, there was already a wave in the more sophisticated institutional market towards getting more of the assets out of the traditional and into this traditional alternatives, especially venture capital, real estate, private equity, and to a certain extent, hedge funds. For individuals, that's a little harder because oftentimes those types of vehicles have pretty high minimums, right? So it's harder to get in exposure to those. I think where we are now, with a lot of us as individuals having built our portfolios around an idea of the bond portion giving us more benefit than we got this last 12 to 18 months, I think a lot of people are really starting to question that allocation. So I think you're entirely right that something like a 50-30-20 or whatever it might be, where you take 20% of your portfolio and look for other alternatives, could be gaining in popularity on a more permanent basis. But it really depends on your ability to access things, right? I can speak till I'm blue in the face about great hedge funds and all that, but if I'm only trying to invest $25,000 or $10,000, I'm not going to get access to these hedge funds.